Hey everyone, welcome to another edition of the Buddy Study Group. And today we are joined by Miss Rhonda by phone. She is such a champion that she is struggling with an internet outage today and still agreed to join us by phone. But she is going to be joining us and talking about a topic that I told you guys a couple of study groups ago. I was going to bring this as its own session because I think it's underrated, underused, undereducated about, and Rhonda is one of the best I know at speaking to people about the long-term care partnership program. If you are leaving partnership products out of your portfolio, you are potentially missing out on opportunities to help a lot of families in a big way, in ways you can't with other types of long-term care insurance. So Rhonda's going to go through Partnership 101 and a little bit about the program and maybe a little technical stuff if we have time. So, Rhonda, thank you so much, and you can take it away whenever you're ready. You are on mute, though. Uh-oh. If I can ask you to unmute, will that give you a prompt to unmute yourself? There we go.
Yay!
We're gonna find a way, no
I
matter
tell
what.
you, we're gonna talk today and this whole day, and I just want to give a preface. So I want everybody to know I'm not totally illiterate here. I'm borderline, but not totally. Got up this morning and no internet, and I'm trying different devices, trying the TV, doing everything. And so I give up, call the cable company, and that, yep, there's an outage. It's not so much an outage, but they're working on an upgrade system. I'm texting people because I got a full day of mostly meetings, not so much appointments, but meetings. And so I'm like, okay, but they're like, well, 8 to 5, who knows when it's going to work. So I've been doing all this. And then I get on my phone here and I'm looking at the emails. I can't find the link. So Jason sends me the link and it's got unmuted. It's got me muted, but I'm sitting here punching everything. I can't find how to unmute on my phone. But all this to say, this tells us that we can learn to pivot. We have to have different tools when we have to do what we have to do. And that's kind of what we do with long-term care. We have to have different tools in our toolboxes. When we're talking to family members, we may need to pivot and do different things. And whether it's communication, it's email, whether it's Zoom, video, phone, using your phone, I was trying a hotspot on my phone. I mean, whatever it is, we will try different things. And that's kind of what I'm thinking about our messages today. So I love our topic today. It's about partnership. So, what I wanted to do is just take a little bit of time and take you through the timeline of partnership, where we started, where we're at, and why I feel it's relevant and why it's relevant for some clients, maybe not for all clients, but why I feel it is relevant for some clients. So we're going to go way back in time, back in the probably 80s under the Woodrow Wilson Foundation. They said, hey, we really need to start promoting people to purchase long-term care insurance, private insurance, because they already saw the need way back then about people aging, healthcare costs rising, and the pressure on Medicare and Medicaid budgets. So they came up with the partnership program. And to me, a partnership is an agreement between two parties. So if you write a policy, the insurance carrier is going to pay you commission. You have a partnership. You get married, you have a partnership with a husband and wife, you have a partnership, better for worse, richer for poor. You have an agreement between two parties. So partnership long-term care is not a whole lot different. There's just the two parties are the state that you purchase the policy in, their Medicaid department, and your private insurance company. So those two parties have a partnership that says, hey, if you, resident of this state, purchase an individual policy, and if you exhaust all of your benefits, we, Medicaid, will not make you spend all of your assets down to that $2,000 spend down. Now, hang on, I'm going to walk you through this a little bit, but just bear with me. And what that did is say, let's, for an example, say I bought a policy, it paid me $300,000 worth of long-term care. Long-term care paid $300,000, and I still need care. Instead of spending all my assets and spending down to $2,000, the state would allow me to retain minimally $200,000 in assets. So we originally had the four states: Connecticut, New York, California, and Indiana. And with that, we had those states, but fast forward, we've had this timeline of long-term care. I don't care which administration, every administration has been looking at the need of growing needs of American people: aging, healthcare costs rising, Medicare, Medicaid budgets. So fast forward in 2002, President Clinton signed in the Tax Qualified Act bill that said, hey, if you purchase long-term care, we're going to give you guarantee that those benefits are paid out tax-free. And then they started adding some tax deductibility for business owners. Fast forward along the timeline, we had 2005 came in, and that's when things really started shifted under President Bush. 2005, he signed into law the Deficit Reduction Act, the DRA. If you're not familiar with it, get familiar with it. It's a popular term. You need to know about it. So the Deficit Reduction Act basically said, hey, we got a lot of people out there cheating the system, right? We got, oh, okay, grandma had a stroke. She transfers the farm to her son. And now technically grandma has no more assets, and she's applying for Medicaid because she has no assets. And you and I, the taxpayers, are paying for grandma's care. Meanwhile, the son sat on the $1 million farm. So there's a lot of people that are always working in the system to see how can we win and keep our assets and get qualify for Medicaid. So that was one thing that happened out of the DRA. They said, hey, we're going to create a 5-year look back period to see if assets were transferred. And it was no longer from the date of transfer, it was the date that you apply that they're going to look back 5 years. So they're making it harder to meet that qualification. Another thing that came out of that DRA was we had a lot of people saying, okay, I've got $700,000 in my 401k. You know what? I'll go ahead and annuitize it. And that'll create a set income for my spouse to have income. So technically I'm eligible for Medicaid because my asset's gone. So what they also did out of the DRA is they also created an income means test, because prior to that, had an asset means test and a health means test. So now we're going to say, okay, we're not going to just look at, did you spend all your assets down to $2,000? We're also going to look at, hey, how much income do you have? And that gets into really nitpicky situations, but we have some states that have income cap states that say if you have too much income, you're not going to qualify for Medicaid because you have too much income. All right. We can have this discussion all day long, but I'm going to keep trying to move this ball around for you, Jason. But the other thing that came out of that DRA was partnership. President Bush says, why don't we have all states offering partnership? We've got those 4 original states. Why would we not require all states the ability to offer that partnership? Because it's not costing the government anything. Because remember, they're buying private insurance, and the private insurance is paying first. So now we have all the states. And if you've not wrote a long-term care, which I'm hoping most everybody on here has, but you all know you had to take that 8-hour partnership certification, and you have to do your 4-hour refresher every, 2 or 3 years, depending on your state. So we have partnership. Couple things with partnership is it is traditional policies only. Okay, so if you want your hybrid, your Nationwide, your One America, Lincoln, Bright House, Securian, you're not going to get a partnership. To get a partnership policy, it must be a traditional policy. The 3 that come to my mind is your NGL, Mutual of Omaha, and Thrivent. Obviously, you can get like New York Life, Mass Mutual, some of those other policies. Now, in order to be partnership, you have to have several things in place. Number 1, you have to be in a state that has approved the partnership law. So just because 2005 President Bush said, hey, we, the federal government, we're going to oversee it, but we're still going to give all the states underneath the rights to run their insurance per how they feel to run their insurance in their state. They're going to give them that federal approval to say, hey, we're going to go ahead and say, hey, you can have partnership. Believe it or not, we have a couple straggler states out there that are not partnership certified. But number 1, you have to be in a state that partnership is eligible. Number two, you got to make sure the insurance company's plan meets that state's partnership certification. Number three, you, the agent slash producer, must be partnership certified. So again, you have to take that original 8-hour certification. You have to have your 4 hours. Then it goes into, does your policy meet in order to qualify to be partnership? Kind of like in 2002, we had tax qualified that said, hey, you had to have 2 of the 6 ADLs, you had cognitive impairment, minimum, 90-day stipulations. To be partnership, it's pretty simple. It has to be a tax qualified product, which means it's comprehensive. Got to have home care, community care, facility care. And depending on your age, there's an age-based table. Depending on your age, it has to have a certain inflation amount. And the concept is pretty simple. We don't want 50 and 60-year-olds buying a $100 daily benefit with no inflation. Fast forward 20 years. We already know, I don't care which state you're in today, but $100 a day or $3,000 a month is probably half of the cost of care pretty much anywhere you're going to go. So fast forward another 20, 25 years, that's going to be, maybe an eighth of the cost of care when you need care. So they did require that you have inflation protection into those policies if you want it to meet that asset protection. So what they're saying is you have to have a policy that's going to be not only creditable today, but it's got to be substantial and creditable at the potential time that you're going to go and claim in your mid 80s. So they have typically, you see 3% compound inflation. I believe it's age 76 that when you turn 76, if you are applying, which good luck. I mean, 20 years ago when I started doing this, yeah, we were right in late 70s and 80-year-olds, so maybe I didn't have to put that in there. But today, if you can get somebody 76 applying that has the premium and the health to qualify, go for it. Good for you. But you're not, you probably, chances are high, it's not going to happen very often. But long story short, I think the cutoff is age 76. We don't talk to too many people, traditional policies at age 76, but if they do, they're not required to have that 3% compound inflation to meet partnership. Okay. So now let's dive into, again, the specifics on how partnership works. So with that, I'm going to take you through a little bit of Medicaid 101. Okay. Medicaid, remember, is aid for the poor. So it's funded from tax dollars. Don't confuse them with Medicare. Medicare is your health care. So Medicare says the left arm of the government, and Medicaid's the right arm of the government. Two totally different programs. But equally, we're funneling tax dollars through the head because it's going out to both sides of the body. Okay. Either way you look at it, we don't have enough tax dollars to support either one. Medicaid, unfortunately, is the biggest payer of extended nursing home care. It's also relevant to understand that Medicaid only covers nursing facility care. So everybody wants to go to the assisted living. Why? Because those rooms are like condos. You have this huge room, you got a bedroom, you got a bathroom, you got your living room unit. It's like my dad's condo. Okay. You go down, you can have meals, you're able to ambulate, you're using a walker, a wheelchair, you can get around. You have this wonderful facility. You can order off the menu. If you don't like it, you can order something else. You have all these great activities. They're like hotels. That's where people want to go. But it's relevant to understand that Medicaid does not cover assisted living. Medicaid is paid in a nursing facility. And that typically is when you bring up the conversation of a long-term care or a nursing home, they say, I'm not going, because they think in the back of the mind, they're going to go to the nursing home. That's the one place they don't want to go. So when you're having the conversation and people think, well, I'm not going to buy insurance because I'll just spend my assets and qualify for to go into a nursing home. Well, they need to understand the nursing home is the one place that typically people say, I don't want to go. So make sure you understand Medicaid only covers nursing facility with one little exception. That exception is most states or all states have what they call a home and community based waiver program. So if you think about it, it's a lot cheaper to keep somebody in the home than it is to go to a facility and pay that room and board facility bill. So the states allow a certain amount of tax dollars if you are in a situation that you could stay at home. So typically you got to have somebody residing at home. So if I'm single and I'm homebound and I need Medicaid and I need 24/7 needing care, probably not going to be a candidate for that home and community based waiver program because usually I find it's cheaper to go to facility if I need more than 8 hours of home care because now you're trying to manage three full-time positions providing care at home. It's just cheaper to go to the facility. So is the home and community based waiver program. Do know it's a very small fraction of what Medicaid pays is for that home and community based waiver program. Even the state of New York, who's been very generous with their home in New York or home based waiver program, even New York is starting to tighten up because a lot of people have been taking advantage of that. So again, any state you're in, Medicaid is a huge budget and expense, and it's a concern. So that being said, most of Medicaid's covered in a nursing facility. Very small percentage is covered at home care, and none of it is covered in the assisted living. So let's run you through a situation. Let's say you have a husband and wife. I don't care if it's the first marriage, the second marriage. When you have two people living together, you're sharing household expenses. It's just the way it is. Okay. He's paying this, she's paying that. This one's paying this one's paying that. However you want to look at it, typically you're sharing something. What happens when one spouse needs care? They have a new income concern. It's an income problem. So now all of a sudden they're getting another $6, $8, $10, $12,000, 14, 16,000 a year in California a month bill. How are they going to pay for it? Because we typically like to pay our bills out of our income, most people do not have enough income to pay the additional 6, 8, 10, 12, 14, $16,000 monthly bill. Now, remember, if you're a couple, you have two people in one household paying all the bills combined. Now, one spouse is gone because majority of the care for Medicaid goes to a nursing facility. Their income is going to go to pay as much of the bill as possible. Unfortunately, they're not going to have enough income to pay the bill. So now they're going to dip into their resources. And to me, a resource in simple terms is assets. So what is an asset? You got a checking account, you got a savings account, you got a money market, CDs, maybe you got a high yield savings account, you got a 401k, you got a non-qualified account, maybe you've got an annuity that you've been contributing to, but you haven't annuitized it. Maybe you own some stocks, maybe you have a beach home. Anything that you can substantially put your hands on, cash it in, the government, IRS, Medicaid's going to say, hey, you dip in, use your resources first before we ask taxpayers to pay for it. Okay. So what happens here is you've got now a couple that was sharing expenses. One spouse needs care. They're in a facility. Their income goes with them to the facility. They don't have enough income to pay the bill. Now they're dipping into the assets. And when you are married, it is combined marital assets. So when you made that vow for better, for worse, richer for poor, better for, sickness and health, I sure as heck hope you really did it to mean it, because that's really what's going to happen. It does not matter if I worked and I had an IRA, a Roth, a 401k, if I inherited anything and my better half had what they inherited or what they have in their accounts. It doesn't matter. When your social security numbers are linked, you're better for worse, richer for poor, sickness and health. So everything goes into one big pot. And the Medicaid will take a snapshot at the day that you apply to look at all of the combined marital assets. Now, first thing they're going to do is they're going to say, we can't take everything away because we have to leave what they call the community spouse. And I think of the community spouse as the healthy spouse. We have to give them something to live off of. So they're going to allow them one home to live in, one automobile to drive. So if both spouses have their own car and one spouse goes to the nursing home, the community spouse only needs one automobile to drive. So they're going to use that automobile, they're going to sell the other one, and they only need one home to live in. They can have half of the combined marital assets up to the state allowable maximum. So we call it, we have a floor and we have a ceiling. The ceiling is this year like $157,000. And of course, I'm not in front of my computer, but it's about $157,000. So what does that mean? Let's say you've got a husband and wife, or a couple, I should say, and maybe together they have $1 million in assets, not counting their home. Okay, so we added the 401ks, checking, savings, money market, CDs, Roths, whatever it is. We added together, that's $1 million. The healthy spouse gets a home to live in, one car to drive. Oh, thanks, Diane. 162,660 is this year for 2026. Diane, thanks for having my back. You're awesome. I think maybe 157 was last year, but whatever. So out of that $1 million, because we're going to take the home out of the equation, the car out of the automobile out of the equation, everything left stays $1 million. Logically, the healthy spouse is going to say, well, Rhonda said I could have half. Half of $1 million is $500,000. Well, Rhonda did say you could have half. However, there is a ceiling or a maximum that they will allow you, Medicaid will allow you to have. So that is that $162,600 that Diane just put in there. So of $1 million, the healthy spouse is going to get to keep $162,600. That means the remaining portion, so $1 million minus 162 is what? 837.5, 837.4, something like that. Is that close enough?
Thank you, got it.
So that means before Medicaid is going to give you an application to apply, you're going to have to spend down that $1 million, not all the way down to two, but you would spend it down to 160. You would take the 162.6. So that would take you down to the 840, what did I just say? 838, something like that, 837. You would spend that $800,000 number down to $2,000 before you could apply for Medicaid. Meantime, you've got the healthy spouse sweating a bullet because now they're paying 100% of property taxes, insurance, utilities, insurance, you name it, on one income. They don't have two. And the other spouse is chipping away at all the assets, and it could be part of their own assets, and they're only going to get the 162. So now this is where long-term care is relevant and partnership is relevant. Let's say they purchased a private long-term care policy that was partnerships qualified, and it paid $300,000 for care. And after the $300,000 of insurance is gone, let's say that spouse still needs care. Well, obviously the insurance is gone because they paid what they promised, but they still need care. Now partnership comes in and says, wait, you had partnership long-term care. It paid $300,000 for your care. We are going to allow you to retain $300,000 for your care. So in that situation, they had $1 million. The healthy spouse gets the 162. The unhealthy spouse's portion of the marital assets is that 840. Why can't I keep remembering this? 837 number. Instead of spending all that down to two, they would spend that 837 down to 537 because the law is going to allow them to retain the 300,000 that the private insurance paid up front. Is 300,000 of assets that is going to be allowed to retain. Okay. Now, what I love about the law is several things. A lot of people do not understand Medicaid is treated like a loan. So all these people that think it's so easy, I'll spend down, qualify for Medicaid, they don't understand is it is a loan, and eventually the loan will be called due. Now, most of the time with couples, when that spouse passes away, there's nothing to recall because they still got to leave the healthy spouse a home to live in, a car to drive, and the 162. But it's when the second spouse passes away, if there's anything left, or now if the home is sold, the Medicaid loan is now due, and now they will be first in line to get their money back. So it's called the recovery law. And the federal government has implemented all states the right to have the recovery law. In fact, they require that they have the recovery law, or they do not receive any federal dollars to go into their state Medicaid budgets. So the partnership not only allows to protect the 300,000, every dollar of insurance is dollar of assets protected. It's also exempt from the recovery law. So now if I have $1 million and my spouse gets to keep the 162 and I had 300,000, instead of spending my $840,000 down to 2, I'd spend it down to 502 because my insurance paid the first 300. I spend down, qualify for Medicaid, and let's say the state of Iowa pays another $200,000 for my care before I decease. I pass away, and at the time of my spouse's passing, that loan is not going to be due. It's already forgiven because I had partnership long-term care. They're not going to come back and ask for the 300,000 back or the 200,000 that they paid. So every dollar of insurance truly is a dollar of assets protected. Okay. Now, what I love about the law too is I don't have to overinsure people. If I have people that have, modest middle class, they only have $500,000. I don't need to be signing them up for, 5, 6 years of benefits and, signing them up for $1 million worth of insurance on day one. I don't need to because the law is going to allow them every dollar of insurance is dollar of assets protected. Another scenario is just because they have, I'm here in Iowa, we got a lot of, $5, $10 million farmers sitting here on land, but they don't have very much income. So doesn't mean you have to buy $5, $6 million worth of insurance. You buy as much as you want. Most people will say, I don't mind paying some of it. I just don't want to be exposed to paying 100% out of pocket. So you can pick and choose, but every dollar that you choose to have the insurance pay, should they exhaust the insurance, is a dollar of assets that is protected from that Medicaid spend down. Okay. And this is going to create huge peace of mind for that other spouse. Okay. Now, I do think partnership is really great for mostly our middle class and maybe our on the lower end of that middle class, because couples that maybe have less than $1 million in assets, knowing they've got 300, 400, $500,000 tax-free dollars coming in, they still love their family. They don't want to be a financial burden. They don't want the spouse or the kids to have to physically take care of them. It's still going to provide great peace of mind for them and give them that asset protection piece. And I don't know which parent wouldn't say, hey, if I'm gone, whatever is left over, I kind of like to leave it to my kids. Maybe they don't feel like they need to leave everything, but sure, they usually want to leave something. And so that's what that partnership does. Even more important, it does for that spouse. So if you have that second person, that partner spouse, and you want to guarantee some asset protection. So if one spouse is gone, they want to make sure they have some extra assets to help make sure that they can maintain their retirement lifestyle. To me, that's where I think it's relevant. If you have people that have $4, $5, $6 million, they're probably not going to buy that much insurance. So the partnership may not be so relevant. Excuse me. Likewise, if you have people that only have $50,000 of assets, maybe they're renting an apartment, probably don't need partnership because it's not going to take them much to spend down, qualify for Medicaid. That's maybe when you're looking at those bankers policies, or maybe you're looking at the short-term care policies to buy them kind of a bridge until they can qualify for Medicaid, but still be a great tool to help their family members because even if they don't have a lot of assets, the reality is they still love their kids. They probably don't want their kids to have to help them, 24/7 being around at the home to help take care of them. So I
That's a
really
great point you make, Rhonda, is that like sometimes we rush to blanket partnership as something that is a boon to middle class clients across the board, but you really do have to take assets into account at the end of the day, as you do with everybody as general practice. But we do have a couple of questions if you're interested
Sure.
from
And I
folks
do
in the
not,
chat.
I do not see them. So
Yeah, no problem. Natalie had asked, does that apply if monies were not commingling? Sorry, Natalie, I know some time has passed, but if you want to unmute and clarify so that Rhonda can help to answer that for you, feel free. Or if she already answered it, let us know. And then Romeo said, will you cover short and fat versus long and lean for benefits?
yeah, so again, it kind of depends on what their situation is. Hopefully we did our good job fact finding. I always like to know, do they have pensions? Is it a small pension? Do they have multiple pensions? Are they claiming Social Security at 62? Are they claiming it at 65 or 67? Are they going to delay it to 70? So kind of get an idea of their income stream to see, what other sources of income they have. And then I always like to ask, are you going to be spending 100% of your income? Or are you going to be able to bank some money? Are you taking your RMDs because you only have Social Security and you need to supplement your Social Security? Or are you taking your RMDs because you have to? Or are you going to delay them? So that's going to kind of tell us about how much income they have. So typically, my people that have really good pensions, typically are educators or maybe government workers or union workers that may have incomes pretty close to what they were working in retirement. They may need the long and skinny Romeo that says, hey, I just want to guarantee that I've got, a longer duration, but always having some tax-free dollars coming in. However, if you have people maybe have low assets and maybe low income, probably going to need a short and fat, right? Because it may not take much to qualify for Medicaid. Again, depending on if they're in a cap state or non-cap state, but some states that have that income means test in place, it may be really hard for those people with pensions to qualify for Medicaid because they have too much income. So again, maybe they want the skinny and long policies, where maybe some people that just have, $300,000-400,000 in assets, but they still want to have some asset protection. Maybe we do the short and fat. Do a good 6, 8, 10,000 a month for 2 years or 3 years, just get a basic policy. Does that make sense?
Yeah. Romeo, is that all good with you? Perfect. Let's see. I think everything else comes from folks just adding a little bit to the conversation. Diane said with some carriers, they can drop their inflation after age 76 and still maintain partnerships. This helps when older clients receive rate increases. That's a
Yes.
really, really good point. Romeo says, as spending down, don't forget IRMA, which can triple your Medicare Part B premium. And I think we've
You,
covered everyone else in the
you know,
chat.
Romy, I respect that comment, and I pretty much have that with people every day. Or not, maybe not every day, but what people don't understand when they think they're going to self-insure is when they take money out of those accounts, and the majority of Americans' wealth is in qualified accounts. Okay. That's why they're having RMD requirements. Hey, you've not been paying tax on it. We want our taxes out of it. So when they take money out of that, they have to pay taxes, which is going to also create income stream, and that's going to increase on IRMA for your Medicare premiums. So often I get, I've had a couple people call me and say, "Hey, how's come my Medicare premiums went up so high?" And I'm like, "What are you talking about?" Well, after fact finding, I figured out they're talking about their Part B, and I said, "Oh, well, did you sell some of your stock?" And they said, "Well, yeah, my financial planner wanted me to move some of my qualified dollars over to a Roth to create tax free." Well, yeah. So you move $200,000, now you got extra income, and guess what? Now your Part B premiums go up. And to your point, Romeo, I had this discussion yesterday. Was working with a pilot, and he told me from day one, he said, um, the hard part is going to be convincing my wife. Now, they both were married, affluent, white collar, but no kids. And they both have nice income streams. And he told me from day one, it's going to be a hard time convincing my wife. He's a pilot. So met with him 3 times. He's on board. And every time he told me, he says, it's going to be a hard time convincing my wife. I get it. I like it. Bump, but it's going to be a hard time. So he emailed me back and he said, thank you very much. We looked at it, everything. We decided not to do it. So I emailed him back and I said, first of all, thank you for the opportunity. Appreciate it. Appreciate your feedback. But I said, I strongly encourage you to have a plan for your disaster. I said, it's not any different than you stepping foot in that cockpit. You have a co-pilot in the event that a disaster happens. And you have a communication tower that you can tap into. When you have a long-term care plan, that's what you're getting. You're getting a co-pilot and you're getting access to the communication tower. When you don't have a plan, I said, I cannot think of any other plan that you can get everything in one. You can definitely say, I'll dip into my resources and I'll prepare to pay the taxes. But now you have nothing but medical expenses. You're dipping into your accounts. You're paying taxes because you're taking it out. Now, of all things, you got all these medical expenses, and now your Part B premiums are going up, and maybe your Part D premiums are going up. You have nothing but medical expenses, and now your premiums are going up because you have medical expenses because you're taking money out to pay taxes. So I said, I don't know any different. I said, I don't know if you're going to need care or not need care. Just like any flight attendant doesn't going to know if you're going to have a surprise landing on water or land. But you know what? We go through and we prepare for it. I said, I highly encourage you to prepare for a disaster because right now you two are married. You two are each other's co-pilot. What happens if the co-pilot still needs access to a communication tower? And so that's where having a plan, even if they still love their family, still have kids, they still have somebody that's important to their life, but they don't have a lot of assets. Eventually, Medicaid is going to be there. And we all have all seen where all the Medicaid, issues. Anybody that's dealing with Medicare, it's harder and harder to call and get through. They're just pushing everybody to do online. And if you can't figure it out, they don't really care. They're just making it harder and harder for people. And so I think we're going to continue to see that. That's my opinion. I got off track there, didn't we?
But it's all good knowledge. So Matt in the chat said, besides starting conversations around long-term care and uncovering needs, what are some practical ways to move prospects more smoothly toward a decision so I can close more consistently without it feeling forced? I predominantly sell life and annuities, and you're really good at this one too. And we've had you do a couple study groups on this topic alone.
Yeah. Um, Matt, I'd like to say I close them all and I don't. I would love to say that. I just, again, ask them, what sparked their interest. Why are they looking into long-term care? And usually they'll tell me, oh, I'm either dealing with a parent and I don't want my kids to have to go through what I am. And I write that down. So when I start to get pushback, I go back to their why. Kind of like, other people say, what's your why? What's your why? Why did you pick up the phone? Well, I don't want to be a burden to my kids. I don't want my kids to have to do this. So make sure that we keep their why, their focus. And then as you walk through your presentation of, however you do your presentation, but what is long-term care? How does it work? Have some checkpoints with them. Um, you know, have you can you think of any other product out there? Can you think of any other plan design that can meet your needs and do all of this for simply paying a premium? If they're self-employed, don't forget to talk about the tax deductibility. And then, talk about how, today your health is good, but often I meet with people and they have health issues. Now they want it and can't get it. Um, long-term care is also opposite of like long-term disability. If they have a long-term disability product, find out if they do have a long-term disability. Why did they purchase it? Well, I have a long-term disability product because if I'm disabled and can't work, I still know that I have to uh, pay my property taxes, my insurance. I have to pay all those things. So I have to make sure that I have enough income to pay for all those other situations. Long-term care is not any different. Now you're retired, your income may be the same, but you have a whole new set of expenses. So you still need that income. If they do have annuities, Matt, ask them the question of why did you purchase an annuity? Why? You wanted to make sure that you had enough income to sustain you, your spouse, the both of you. Well, what happens? What can derail an annuity plan? If I have an extra $8, $10, $12,000 monthly bill, that can derail it. So maybe just taking some time to um, ask some of those questions up front as to what plans they have in place and why did they have those in place, and helping them to know this is one more area that can derail every long-term care event is the one thing that can derail everything else. Right? Except for life insurance. Except life insurance, if you have a cash value, now you could. And by the way, Medicaid is going to require you, if you have cash value life insurance, they are going to require you to derail your life insurance. They're going to require you take that cash out. So, in some ways, if unless you have term, even life insurance, a long-term care event can derail every other plan that you have in place.
That's perfectly said. And yeah, I think the one takeaway I've always gotten from you in sessions you've done on that topic is figure out their why, write it down, and especially if they start to disappear on you, go back to that why, right? Remember, you told me you wanted to do this because, and we haven't solved that problem yet. So I've always taken that as great advice from you. I just want to quickly share two resources from our good friend and mentor, Phyllis Shelton. I'm going to put a link in the chat, and I'm also going to share this page. I know we got to get Rhonda out of here in a couple minutes, but Phyllis has this wonderful tool, What Your State Lets You Keep. So by state, thanks to Phyllis, you can see asset allowance for yourself, your spouse's minimum asset allowance, your personal monthly needs allowance, and your spouse's minimum monthly income allowance by state, all in one place to refer to as a nice cheat sheet. And Phyllis has always kind of been my sort of go-to resource on things partnership when needed to look up. And she also has on this same website, her website, if you go under laws and regulations, the Partnership for Long-Term Care. I mean, if you want more on this topic, you got it. Phyllis is very, very detail oriented. She will not rest until something that is left out is no longer left out. This is very, very all-encompassing, a really good read. And, she gives the easy formula for any other states if you want information on a specific state that you can drill down into. Just Google the name of state and Partnership for Long-Term Care, and you're going to find the page that is similar to the New York partnership state and the other partnership states that she has listed here. So a lot of the regulations are going to be state by state, but we've got some good folks in this community that can really help you stay up to date and get the right cheat sheets. So give those a look. Let's see. Matt said, also, most of my clients haven't really had a long-term care conversation before, so they're not actively looking for long-term care solutions or planning for it yet. In that situation, what would you recommend is the best way to approach or position it for them? I would say personally, just because they haven't sat down and had a long-term care conversation with somebody doesn't mean they haven't experienced it. They hear the word long-term care on its face and they may say, I don't know what that means. When all the while they experienced a close family member that was either in a facility or receiving care at home for a loved one. So it could just be in how it's phrased and introduced, and introducing that as a risk to a financial plan and kind of putting it in terms that they can relate to can be helpful. But Rhonda, I don't know if you have anything else you want to add.
Yeah, along the same lines, just kind of goes back to, hey, you're really, always try to give people compliments so we can keep that open communication tool going there. But say, hey, you're doing really well preparing for retirement. These are things that's really important to you, whatever it is that you want to do in retirement. Have you thought about what an extended care event would be? And if they're like, well, what is that? Well, did you know, the majority of people do need care at some point in their time. Not saying you will need it, but if you do need it, what are your wishes? Who do you want to provide your care? Well, I don't want my kids to do it. I want my spouse to do it. Do you know how much it costs? where's that income? We have not mapped out into this retirement plan that we're working so diligently to get you to. We haven't accounted for anything for extended care. And, we're looking at, 60 to $120,000 a year, depending on what part of the state is. Where are you going to get those dollars? Because we've not allocated those dollars. So that's why we need to have that discussion. And I will prepare you. A lot of times, those people, it's probably going to be more than one, maybe two or three times before it really sinks in. And if you don't have a story for that client, use one from your other clients. Hey, I'm dealing with somebody right now, another client, their parents had to place them in an assisted living facility, and it's costing them, $8,000 a month. And, luckily they had a policy, or maybe they didn't have a policy. They're using their Social Security income, and they're depleting the assets. What is use a story to kind of bring them in, but just basically put them into the situation is if something happens to you, how is this going to affect the people that you love most in your circle?
Love that.
And I
Yeah,
do need to
and
sign off. So
yeah,
sorry.
yeah. No, go ahead, Rhonda. Thank you so much for being a trooper and giving us a really, really information dense presentation. I think it's a great topic, and you always nail it. So thank you so much for everything today. See ya.
Bye.
Yeah, and Romeo
Jason,
and
do you mind if I share something
yeah, go
I
ahead,
think is
Carly.
relevant to this conversation?
Yeah,
So, and it's kind of in response to Matt's question, but I feel like everyone can benefit. I feel like, well, I know that there's really an epidemic of silence going on where conversations are not happening. And one thing, when we approach an older person, a parent, or whoever, and we just address that long-term care or Medicare or whatever it is, they feel a little bit insecure, they feel on the spot, and they're going to be defensive. But one way to also approach it is to just say, this is some planning I'm doing for myself. And it made me wonder, what are your plans? And that really, I feel, is a conversation opener where people are much more receptive to sharing, even saying, well, I haven't thought about that, or whatever it is. But it's a door opener. And I'll just share that a month ago, I got a phone call on a Sunday from a friend of my sister's who said, I need to talk with you. I heard that you are an expert in long-term care insurance. I have a situation in my family and I would benefit that I think would benefit from talking to you. And I talked to her on a Sunday, and what I found out was that this friend who I know has parents in another state who had a Genworth policy that they'd had for 20 years. The father went into the hospital for a fall, and that's when the friend found out that the Genworth policy had been canceled the previous year. I said, I don't know if this is possible, but I can call Genworth with you and find out if there's any possible way to resurrect this policy, if there was any cognitive decline, like something. They declined the wife, not the friend, the wife declined my offer to do that. They said, well, we feel that we've done well in the market, and so we can just pay if we need care and all this other stuff. And my friend, of course, is horrified because she knows that she's going to need to be more involved than she probably would have been if the policy was in place, regardless of whether there's money needed or not. And so, ironically, the next day I was talking to a friend of mine who's a financial advisor, and he said he was visiting his father in Florida who was talking about canceling his homeowner's insurance. He said he never needed it and whatever the case is. And I just thought, this is crazy. And I said to my friend, thank God your father shared that with you so that you could intervene. And I feel like if we just have more conversations with our families, our clients, and find ways to bring these topics up in a non-confrontational way, I feel like we'll all be better off.
100%. Thank you for sharing that. And yeah, I agree. A lot of this does come from silence, right? people just not even having these conversations within their family. Hey, what's your role going to be, or what's our plan as a family going to be if one of us needs extended care? I think that's um, definitely where a lot of people should start, because a lot of families have not had that conversation with each other, and there's a lot of assumed roles that people will be playing that they're not necessarily comfortable with, just like in your story. And I think what Romeo and Diane had to add was great, you know? I mean, Diane said
Absolutely.
just ask them, what's your plan for extended care needs? Presume everyone has a plan because everyone does. And even if it's a bad plan, everybody has a plan. The default one just isn't necessarily that good. So I think starting kind of with those questions, or starting with a story, or both, can really help to just open the door. I mean, are they going to be swept off their feet and get a solution in place the day of? No, but you have to open that door before you can go anywhere. And even inspiring somebody to have a conversation with their family who doesn't do business with you but ends up better off for it. I mean, that's why all of us on this call really do this at the end of the day, besides making a living for ourselves. So yeah, thank you everybody for chipping in on those. And yeah, if you choose not to decide, you still have made a choice. That's a Rush song, isn't it? Um,
Yes.
it's a really good line. Um, all right. Well, that aside, I really appreciate everybody being here today. I hope we can all appreciate Miss Rhonda being a credit to the force and getting on her cell phone with no internet to do that presentation. I hope you all picked up at least one thing that you can bring into your conversations. And yeah, I think we may be canceling next week's study group. Sorry to disappoint. I'll get out in front of it. We'll try to work on something, but a large amount of our team, including Rhonda, is actually going to be at Medicarians next week. So if you're going, give us a shout. Otherwise, we will see you in 2 weeks, or on Thursday if you're on the Thursday study groups. Thank you, everyone.
Thank you.
Bye.